We have numbers coming in from HCL Tech as well, and it seems like it's a deja vu of what happened with Infosys. The earnings of this quarter aren't too bad. The revenue is in line with expectation because the growth has come in at 1% in terms of constant currency. Yes, we were expecting a growth of around 1.3, 1.4% there, but about a slight bit of miss coming in terms of constant currency and dollar revenue, but it's been more than made up by the margin performance because the margin came in at 18.4% thereabouts, if I remember it right, versus the expectation of around 17.6. So that's the big beat coming in, and that's why the profitability is much better than expected as far as HCL Tech goes. However, again, like Infosys, there has been a sharp cut when it comes to the guidance, and that comes as the biggest highlight. They have cut down their guidance, which now stands to 4 to 5% on an organic basis, and the services organic revenue growth is expected to be at 4.5 to 5.5% in constant currency terms. These numbers earlier were the growth in organic, company level was 6 to 8, and for services revenue it was 6.5 to 8.5. So there's a cut of almost 200 basis point as far as both the upper and the lower end is concerned of the guidance. In fact, for the upper end, there's a sharper dip because from almost 200 basis point range, it's been narrowed down to 100 basis point. EBIT margin, however, has been maintained at 18 to 19%. This time they delivered in line with those expectations at 18.4%. But overall, it looks like it's a miss when it comes to guidance. Now, the TCV of new deal wins is a little lower than what Street was expecting. It's $3.9 billion. Part of the street also had the expectation of $4 to $5 billion. Yes, there was a part which was expecting 3 to 3.5 as well. So it's broadly in line with the larger estimates, but not the highest estimate on the street. And I say that because for Infosys as well as TCS, we had seen almost a record high number coming in terms of deal pipeline. It seems to be the case for HCL Tech as well, which is the deal bookings of almost $4 billion. CVK says is at an all-time high, and that's driven by a standout mega deal, which is Verizon, of course, that we know of. Attrition has come down to 14.2%. They have added 3,630 freshers, but the net headcount is a reduction of 2,299. It's the digital revenue, which is up almost 3.8% on a YoY basis. Software revenue is up 3.6%, but my guess is there's a bit of a slip happening on the PNP or the ER&D segment, and that's what is causing a bit of a miss coming in. So, in a nutshell, for HCL Tech, the guidance cut is a disappointing metric. Revenue is also lower than expected, but margin, TCV and profitability are a bit of a beat.
One of the big highlights of the quarter is our operating margins. We recorded an 18.5% operating margin, which is a 154 basis points improvement at the company level, and at the services level the margins improved by 212 basis points. This margin improvement is primarily through driving efficiencies in our managed services engagements through automation and AI ops capabilities. We also significantly reduced our dependence on subcontractors. We used our own employees to replace subcontractors, and we also controlled some of the discretionary spend like travel and other costs during the quarter, which eventually has delivered an exceptional margin performance. Another very big highlight for this quarter is our bookings in this quarter is at an all-time high, and for your reference, the booking numbers that we share is the TCV of the net new deals. It does not include rate card deals. It does not include renewals. All of that is not included. These are new contracts signed with customers. It's at an all-time high at $4 billion. This is a 154% growth from a quarter-on-quarter perspective and a 67% growth on a year-on-year basis. To get into some more details of our quarterly performance, our service revenue, IT and business services grew 4.6% on a year-on-year basis and 0.9% from a quarter-on-quarter perspective on a constant currency basis. Our engineering services delivered a very strong growth of 5% sequentially on a constant currency basis, including the ASAP acquisition that concluded on 31st of August. HCL Software continues to grow well. They continue to deliver 3% plus ARR growth from a Overall revenue perspective, 3.6% year-on-year growth in constant currency in our HCL software business. Four of the verticals grew very well. Our retail CPG vertical grew 7.5% quarter-on-quarter, followed by telecom and media, which we had highlighted last quarter that it was weak, but this quarter telecom and media vertical has grown 6.2% quarter-on-quarter, which is again a fantastic performance. These are really attributed to very good execution of the deals that we won in the previous quarters, which is really translating to revenue. We continue to have a strong run in our financial services and our life sciences verticals, which all reported good growth, both sequentially and year-on-year perspective. In terms of geographies, our growth markets, which is really the markets outside Americas and Europe, which is really our Asia Pac, Japan, Middle East, and India markets, delivered a growth of 6.1% on a sequential basis. And Americas and Europe both grew about 3.9% on a year-on-year basis, all in constant currency. Our attrition continues to trend down. It's at 14.2% on a quarter-on-quarter basis. It's a 2.1% drop, and it is the lowest that we have experienced since the first quarter of FY22. Our employee count decreased by 1% on a sequential basis because we have consciously not backfilled some attrition, because a lot of freshers whom we hired in the last 18 months, they've got trained, they've really become quite experienced in the client engagement, so we have largely backfilled our attrition through the freshers.